Okay, we're gonna check out our calendar to start the meeting off. Um, all right, so we just went through the July 4th holiday. We were expecting um, a good return this week because July 4th almost always has um, a good return. People are excited about having a day off, and there's lower volume, and whenever people have great spirits, they usually have the stock market going up. So, so the stock market was up 2% this in the past week. So we're right now in the stock market, we are pretty overbought. We're at let's see, so 75 on the stochastics. So that's pretty high. Let's look at Oh no, we're at 85 in stochastics. Pretty much at the top of our range. We're going into um, a week that's going to have very little news about the stock market earnings. So because of that, we don't expect too much until earnings start coming out. You can see, let's look at the earnings or calendar. You can see that we are starting the earnings this week. So JP Morgan, a lot of the banks start the earnings off this week. And then we start having some big tech stocks report. So we have Netflix and Tesla reporting on July 17th. We have Microsoft, Google, and Apple in the next week. Um, so then we have in August, we have NVIDIA earnings at the end of that month. So we because there's no earnings really coming out in this week, we're going to have like we're overbought now, so there's a chance we're going to be going down or not going up for until the earnings come out. Then July is seasonally a good month of the year, so and we have earnings coming up, so um, that combination usually leads to higher prices. So let's see, and then we have August and September, which are traditionally one of the worst months. So you can see we have almost a 1% return in July usually, and that's probably because we have earnings coming out. Then August, September, we have usually have a bad time, so don't expect too much out of the August, September times. All right. So what else do we have to big picture items do we have here? We have the Fed that's going to be meeting July 30 and 31st. And then what else do we have to look forward to? I think that's about it. We have a holiday in September. Okay, so that's the big picture. Let's look at a little bit what's going on. We had S&P up 2% since last week. We are actually losing momentum. You can see the 50-day moving average, only 43% of the S&P is above the 50-day moving average. And we're only 64% above the 200-day moving average. So we are losing momentum a little bit. We know that the Fed's going to reduce the interest rates towards the end of this year. And we're still overbought in the stock market. So it's not a good time to start buying. Let me see. Okay, the 10-year Treasury is up 1%, and the 2-year is down 1.3% this week. So um, usually whenever the 10-year goes down, the stock market goes up, but it's the opposite this week for the 10-year. What else do we have to say? Okay, tech companies doing great in this environment. companies that do not need to borrow money, which include the big tech stocks that we've always talked about. Companies where earnings estimates are increasing. And it looks like the big tech stocks are also some of the best performing and estimates increasing stocks. All right, so we already talked about the averages, and we're coming into the seasonally weak time of the year. And towards the end of the year, we usually have better returns. Now, let's look at the S&P. Right now, we're overbought. You can see we're at a higher range in the stock market. We're halfway between our channel lines in the S&P. So, let me see. And 10-year Treasury, as the yields go down, you can see we're in a downward trend in the 10-year yield. As the yield goes down, the stock market has been going up. So this inverse correlation continues. And 2-year Treasury is very similar pattern. And let me see. Oil is up a little bit this week. Why is that up? Well, we do have a hurricane coming to the Texas, so that could wipe out some of the productivity of some of the oil companies. But most of the oil companies so far have said it's not going to affect production, but hurricane plus oil usually equals higher prices because there's less supply if they shut some of those oil places down. Also, we have a summer. In the summer, that there's a higher demand for oil because people are driving more. There's always an increase in summer. Everyone knows that. So that's another reason why it could be up. Um, all of our other um, variables aren't changing much at all, so it's not really worth talking about them. US dollar index is steadily going up, so that's going to be bad for the multinationals. We'll show a chart next. Um, okay, this is the US dollar index. You can see that it's going up, so our dollar is strengthening. Because of this, the multinationals such as Google, Apple, companies that sell overseas are not going to make as much when they take those profits from overseas and take them back. Because of that, we're going to have an earnings season where they're going to say, well, we had some problems with foreign exchange currency rates. And that means they're going to earn less because of that problem. So just beware of that. But for me, as a long-term investor, I am just, this is just part of investing. The dollar will strengthen and it'll weaken, and over time it'll equal out. But this is an example of you have to know these things so you're not freaked out whenever a company says, well, we didn't earn as much because of foreign exchange. It's just part of the equation you have to understand. All right, the fear and greed index. We have a neutral, but it's people are getting more greedy. You can see last week it was neutral. We've been steadily over the past 2 months going from fear to neutral, and just when we get to greed, we're well, right now people are getting more greedy, less fearful. It's just not a time to buy because we're overextended in the stock market right now. All right, and to add to all of that, we have a bullish sentiment to the AAII, Amateur Investor Survey. So that combination is you have to let me see, you have to basically don't buy or take some profits. All right, so let me see. The VIX is super low and it's staying low. That means people are not fearful. We watch this because we have to know what kind of environment we're in. We're in a very, very low volatility environment. we this is the probably the longest we've ever gone without a 1% or a multi-percent correction, 2% correction, 5% correction. And everyone on TV is saying we're due for a correction, but in reality, you have to take the corrections as a long-term investor, and you can't be too freaked out if that happens. Now, um, our emotional survey, we're basically getting people more interested in the stocks. So we're gaining some enthusiasm. We're getting from going from fear to neutral, and pretty soon we're going to be agreed. Um, and we're approaching two of the worst months of the year, so don't be surprised if we have some fear and capitulation coming up. Um, we're keeping track of issues that may lead to a crash. None of these are coming out, are happening this week. So we're not going to expect a huge crash at this time. All right, so the PE ratio of the S&P is 24, and the average of the PE of the S&P over the past 10 years is around 17. So we're going to go over some predictions for next year later on, and they're saying that maybe we might have a 30% correction, and it's and if that happens, you have to understand that that's just bringing us back to a normal amount that you pay for stocks. Right now, we're overextended, so don't be surprised if we go down 30% someday. It's just part of being returning to the mean. All right, and I updated this today. We have a forward PE of 20.7. It's above the 5-year average of 19, but the 10-year average is 17.8. So over time, we're going to be going back to 17, the mean, the average PE over the past 10 years. So don't be surprised if we go from a 20 PE to a 17 PE. All right. Okay, so we're tracking our first to worst every week. The communication and IT sectors are continuing to be the best sectors, primarily because they have the best earnings growth and the best earnings, consistent earnings, and they don't need to borrow money, these sectors. So let me see what else we have here. We have the consumer discretionary sector up 15%. The utilities, which was down 8% last year, is up 8% this year. So that's a big difference. Um, the financials are up 10% this year. So that's really good. Real estate is the worst sector this year, is minus 4%. And that's probably because of the interest rates remaining higher for longer. We're keeping our theme for this year. Since the beginning of the year, we've been tracking the AI revolution and weight loss drugs, and all the related stocks for AI revolutions and weight loss are doing really good. We have for the AI revolution, building out the data centers, demand for electricity, the cyber securing the grid, cybersecurity, and utilities are still good themes for the rest of the year. All right, and okay, we're keeping track of the best sectors. The S&P is actually up 16% this year. That's primarily because 30% of the S&P are the big tech stocks, which are doing the best this year. I'd say the bottom 490 stocks of the S&P 500 are only up 5%, believe it or not. So there's a big difference between the haves and the have-nots, and they're basically the big tech stocks. So we'll go over some more of that later on. Okay, so let's look at some of our movers for today for the sectors. We're going to look at the oil sector is, let me see. is down the most. I'm surprised for this because there's a hurricane. We've known about the hurricane coming uh, for quite a couple days now, for 5 days. So I'm expecting the oil sectors to be going up. But let's and as the hurricane comes in and the oil places are shut down. What else is doing bad today? We have regional banking, um, and we have home builders. Okay, so let's look at the 10-year. 10-year is going up. As the interest rates go up, that would explain why the these sectors are affected by higher interest rates. That's, for instance, the energy sectors, not the energy, the bank sector, the home building sector, home construction sector, and financial sector are all affected by interest rates. Let's look at the sectors doing the best. We have gold miners, consumer staples, consumer discretionary, healthcare, and technology. Okay, so I'm not sure why gold is going up a lot today. Hmm, let's look at our cheat sheet for gold. Okay, so gold is down 2.5%. We have a stronger US dollar tends to drive gold prices lower. So we've had a stronger US dollar because it's going up in a straight line, like we said in that chart today, just right here. You can see it's a stronger US dollar. We'd expect the gold prices to go lower, but today, for some reason, they're going higher. So it must be up for another reason. All right, and healthcare, I'm not sure why healthcare stocks are going up. All right, let's look at some of the market movers. We see Meta platforms up a lot. This is one of Dan Now's favorite picks for the year, and we're tracking it. AMD, we have, okay, we have a lot of AI related companies here today. And Meta is an AI. They use AI to improve their sales of their ads. We have AMD, which is makes AMD AI chips, and we have Alphabet, of course, which is pretty big on AI. And what other themes do we have here? We have a lot of drug stocks. Baxter, we have Biorad. One's doing the worst. Hmm, what do we see in common with these? Okay, we have Southwest. We have a lot of airline companies. Um, U.S. Airlines. We have Southwest. We have, and we have some oil companies. Perhaps, maybe that if there's a shutdown of oil refineries in the Gulf due to the hurricane, we might have less output for some of these oil companies. Maybe that's why they're going down. Um, we have Not sure why the airlines are going down, but a lot of the airlines have a lot of debt. And part of our theme this year, the stocks doing the best are the ones that don't have to borrow money. And whenever we have companies with lots of debt, like United Airlines, um, we have Delta Airlines, and mm, perhaps that's why they're doing bad today. I'm not sure. Let's look at maybe the airlines might have flight disruptions due to the hurricane. That could be a reason why the airlines are down today. Okay, let's look at the top gainers in the NASDAQ. ARM Holdings. Okay, these are chip companies. Meta Platforms, AMD, Global Foundries, another chip company. We have Intel. Okay, so the chips are on fire this year. The semiconductor index is up huge, like 70%. The ones doing the worst are Micron. They are a chip company, but they make the memory chips for AI. NVIDIA is down almost 2%. Um, Diamondback Energy. Okay, we have an energy company. Okay, that's all I can really tell from that. All right, so that was a good excursion. Let's look at, let's see. Okay, so this story right here, you can't hide your portfolio from Biden and Trump. So basically what they're saying here is if you have a president that's going to be affecting the stocks that you own, um, you basically can't make decisions for the stocks you own based on who's president because in the past it has not had a great effect on stock market performance. There are industries that are greatly affected by policies such as maybe Trump allowing oil companies to do more explorations, and perhaps that might help that sector. But in general, try to keep politics away from your investments and rely on earnings instead. Let's look at some of our talking points. Okay. Okay, let's look at Dan Now's picks from the beginning of the year. Amazon is up 31%. Meta is up 52%. Texas Instruments took a while, but now it's doing really good. It's up 18%. So, and XBI, the biotech ETF, isn't doing that great. And the KWEB, the Chinese tech ETF, isn't doing great either. It's up 3 or 2%. So, um, it's always good to watch a great fund investor and watch some of his best picks come true. I just picked out some interesting charts. We have a XLV. This is the Healthcare Select Fund, and you can see that this the healthcare fund is out of favor right now. You can see that the stochastics are below around 20, which is pretty low, and it's at the bottom of its channel. So you see it's an upward channel, and it's at the low end of the channel. So my guess is around the summertime, some of the more conservative sectors will be doing better, like healthcare, and some of the tech sectors will be giving back some of their gains. So let's see if that happens. Um, let's look at Apple right now. Apple is on a roll from around May. It broke out of its little downtrend here. It had like, and it's in an uptrend, but it's at the top of its uptrend and it's overbought. So most likely the next stop for Apple will be like right here. So let's see if that happens. All right, so Microsoft, you can see very similar chart where it's at the top of its very defined range, which is very reliable. It's super overbought, and we're coming into one of the worst months of the year. So, and earnings season. It's going to be a couple weeks before Microsoft has earnings. So it might just consolidate just a little bit before the earnings. And then who knows what happens on earnings day. So let's look at Walmart. Walmart is also at a top of its range and overbought. So this is not the time to buy these stocks, Microsoft, and because they're at the top of their channels, they haven't broken out and they're overbought. Let's look at examples of stocks to avoid. Um, we've been tracking the stock for a while and watching the earnings estimates. And this is an example of a stock we're following, but we're following just as an example of a stock to avoid. We avoided this stock like last year, but we're still following it. And we're going to look at the earnings estimates just so we can see examples of red flags when you're investing. Okay, you can see that the stock is oversold right now. And it's basically in a super bad downward trend. Whenever its stocks are in a downward trend, that's just a really bad sign that it's going to keep going down. And it might have to break out of this channel for it to have any chance of going up, the stock going up. But let's look at some of the financials and red flags of why we decided not to continue to recommend this like a year or more ago. Okay, you can see from the earnings estimates, they had a huge loss this year. I mean, this is monumental, and that wasn't expected. So this is an example of a stock that's inconsistent. This reminds me of Boeing. You have these huge losses every now and then. You don't have losses like that with some of the major tech stocks that we're following because they have more consistent business model. But you can see that these earnings, they're not growing over the next couple years. They're actually going down. So the only good thing about this stock is maybe it pays a dividend. That's it. But it had a huge loss, and on top of that, it's not growing. So either it goes sideways or down from here. And, I don't want to be involved with that story right now when there are so many other stocks. And they don't have a whole lot of catalysts like new drugs in the pipeline that are exciting. Um, so right now we're avoiding that one, but you see, it was a good little lesson learned. It was good to go through that exercise. Here's some more red flags. The forward PE is 76. That is huge. And they're not even growing. So you're paying 76 PE for a stock that's zero growth. And the profit margin is negative 13, return on equity negative 25. Okay, so anything negative in these numbers are just a sign that it's not a stable stock. I guess the only good thing about the stock is it has a 6% dividend. But if you're losing your stock's going down in price, it's not worth holding it for a dividend. All right, so let's look at another stock we're following. And let's look at the prospects for this too. It's Starbucks. You can see that it's in a downward trend, very reliable downward trend. It's at the top end of its downward trend, and it's oversold. Let's look at so it's a very good chance, we're going to be going down here and making lower highs, lower lows. And that's not a good reliable growth stock that we've been accustomed to. Let's look at some of the numbers. You can see that they're actually break even from last year to this year for their earnings. So that's not that great. That's probably yeah, it's probably why they're going down. And we go out the next couple of years and we see that they're growing around 12%. And that's really it's really not that great. Their PE ratio is 24. That means if they're growing at 12%, you divide the PE by the growth, and that gives you the PEG ratio. That's PE over growth. And that's 2 times overvalued. So if a stock is trading at 76 now, if you divide that by 2, that's what the price should be. That's the fair value, 38. So right now, it's not a great stock to be buying. And we're just watching it just because of a stock to avoid. And it's it also has challenges. Some of the challenges it has is they're expanding into China, and that isn't going that great. And there's there's some competition in China. There's some coffee chains that are taking some business away from them. So for me, it's just not that exciting of a stock to be owning when there's so many other ones. Let's look at the chart of Tesla just for fun. Um, Recently, we had a breakout of a downtrend. I mean, this was a downtrend for since July of last year, a 1 year downtrend. And it broke out of this and it went up, quite a lot. And we're at the top of this little range we have here. So either it breaks out of this range or most likely it'll go down to rest. It'll go down to this right here and make this chainsaw going. I mean, this steps up. So we'll see if it breaks out of this, but we're in a seasonally bad time of the year. Maybe it'll go down now, but it's overbought. You can see that. I didn't see a whole lot of changes in the earnings estimates that would justify that. We have 20, it's still growing around 23% for the next 2 years. And then 26 to 27, it's only growing 6%. So its PE is 53. That is pretty big. It's expensive right now. So it's growing at 22% only. And the PEG ratio is 2.86, which is around 3 times overvalued. So the fair value of Tesla is around $89 a share. What you're doing when you're buying a stock is you're putting a lot of faith in Elon Musk that he's going to fulfill some of his promises, such as the robo-taxi and a lot of new innovative products, such as the robots. Um, he's predicting that if he comes out with robots, robo-taxis, that it'll be like a multi-trillion dollar company. And they also have a charging station network, which is almost a monopoly. So, but none of that is in the current earnings estimates because this hasn't changed for a year, these earnings estimates. And also we have competition from auto manufacturers. So if this turns out to just be a car company and none of these robo-taxis or robots turn out to be anything, um, it's going to be really hard for the stock to keep going up because they have a lot of competition from these auto manufacturers, and the other auto manufacturers basically aren't making money. They're not profitable in EV sales. I think Tesla is the only company that's actually making money on EV sales. So it's a challenging situation. Until these numbers are going up, I'm not going to be touching this stock. Right now, it's just kind of a really expensive stock for me. All right, so we have a Yahoo article about the stock market will drop 32%. There's an analyst, Peter Brezen at BCA Research. He said that the U.S. economy is going to slow. We're going to have employment problems. The U.S. will fall into a recession later on this year or early 25. And growth around the rest of the world will also slow sharply. Okay, so we have this prediction from this guy, and so we have to like take this guy seriously. I mean, he's pretty smart. We have to we have to watch the price of oil. If the price of oil goes down, that could fulfill some of this growth in the rest of the world will slow sharply. So if we see the price of oil going down, let's say next week to this month, the next month, that will be a sign to us that the growth in the world is going down because there's less demand for oil. And other things that we can look out for is if we have higher unemployment, if we have what other things can we look for? We can look at some of the government numbers to show a slowing economy. If we see any of those things, then his prediction is going to be coming true. and then you have to be more conservative with your investing. And so any stock market, any story like this that comes out, we have to take it seriously. We know that the S&P is 30% higher than the 10-year average. We've already said that earlier today. So dropping 32% is not a big deal. It's just bringing us back to the average of the stock market for the last 10 years. But we have to have a reason. We have to have a narrative, it's called. Why? We just have to, this guy thinks that the Fed is not cutting interest rates fast enough. So if we start getting some interest rate cuts really quickly, like a lot at one time, that could signal that we're going into some kind of recession, and this will come true. And if we do have a recession, the stock market usually goes down 25%. And as a long-term investor, you got to be ready for that. I'm not a doom and gloom person. I'm just presenting this guy's opinion, and you have to look at it and understand it. So what do you do with your stocks you own now? And basically nothing. You just have to be ready to stomach some volatility. You have to be ready for the stocks to go down, and just make sure you're not overextended. Don't borrow money to buy things, and don't buy calls or options whenever you know there could be something like this right around the bend. All right. Okay, so there's an article on Yahoo Finance about a phenomenal stock that could join Microsoft, Apple, Nvidia, Alphabet, Amazon, and Meta in the $1 trillion club. They say the stock is super micro. So we talked about this a month or two ago. This is a stock that puts together systems, AI systems, using Nvidia chips. So the interesting thing about this company, they have deals with a lot of the chip makers to make systems for AI systems. So there are predictions that this industry is going to ramp up in a pretty big way. The company was just added to the S&P 500, which is a pretty big deal. That means the S&P company had to have faith enough to add this company to the S&P 500. So you have that on its side too. Earnings estimates, they're going up 100%, 30%, 19%. So they're going down. They're not growing as fast as they used to, but they're still growing around 25%. Their PE ratio is 47. That means they're about 1.8 times overvalued. But as the Nvidia, gives them business, and they build these systems that are needed, that number might go down to one peg ratio and of one, or we don't know. But right now the numbers in the estimates don't match this headline of this article. But we'll keep track of this stock because it does seem like a stock that's in our theme of AI for this year. And it was recently added to the S&P 500s, and it's a really small stock. It's like 50 billion, which is very small compared to, a lot of these other companies. All right. Let's look at another article, earnings season to test investors' faith in big tech stocks. So I mentioned that this month we're starting earnings season. This week we're starting earnings season. In the next month, we're going to have earnings from Meta, Microsoft, Apple, and then Nvidia is the end of next month. So based on how those earnings come out, that could determine, if the stock market goes up or down. But right now, these companies are making most of the profits in the stock market. And it just seems like a self-fulfilling prophecy. People keep putting more money into the S&P, and these stocks keep doing really good. So and also investors are watching whether earnings growth will broaden. That means right now they're saying most of the profits made in the S&P this year are from the big tech stocks, and most of the gains are from the big tech stocks. The S&P 490 stocks, the lower 490 of the S&P 500, only went up 5% this year, and their earnings are not as real are really low also, and earnings estimates. So um, here's some other things this article said. Alphabet, Meta, the communications sector, which we've been highlighting this year, is up. It's expected to rise 18% this year, but the healthcare sector is supposed to rise 17% also. So that is very important because the healthcare sector is basically out of favor right now. And I was saying earlier this meeting about how the healthcare sector might do better as maybe a broad market correction happens. Um, Let me see. The materials sector is forecasted for a 10% decline. So what's happening is we're going to have earnings season. We're going to have um, a lot of people have been putting a lot of their money into the big tech stocks, and um, we'll see how their earnings come out this month. There's another article um, about how large cap growth funds have performed the best this year in the mutual fund universe. So there's this Wall Street Journal article says the best 12-month total returns through June 30th. That's June 30th from last year to this year. They're all large cap growth stocks. And believe it or not, they have basically almost all the same holdings. Um, and a lot of them are Microsoft, NVIDIA, Alphabet, Amazon, Meta, and Eli Lilly, all of which we have been watching and following for a while. Let's look at some of the holdings of each of these funds. Okay, so we have this is the best performing, second best performing, etc. This is third best performing. Um, you can see that Microsoft, this is amazing. I like to see like huge percentages. That gives a lot of conviction for these companies to hold that one stock. Look, Microsoft in the top holding of some of the best performing for 1 year. Especially, you look at that, three, and Microsoft is in this one, 5%. You can see NVIDIA is in the top two in almost every fund. You can see Amazon in the top three, almost every one of these best performing funds. You can see that they all share similar holdings. Some of the other stocks that are scattered in here, well, let me see. Yeah, you see very similar stocks. So Eli Lilly is one that's been added to a lot of these mutual funds recently. So the lesson learned in this is you have to, if you're investing in stocks, it's in your best interest to buy and hold quality stocks for a long time. Because if you don't, you have to pay capital gains if you take profits. So what I do is I look at some of the best, largest, and the best performing stocks, I mean, mutual funds, and look at their holdings and see what they're holding over time. And if they're holding the same stock year after year, there's a very good chance that if you add that stock to your portfolio, then you'll have similar returns. And if you see them remove some of their holdings over time, then that's a good indication that you might want to really check that one over to make sure it still fits your investing thesis. Um, let's see some of the stocks that, okay, we have Meta Platform these are all the top 10 in market cap stocks. And stocks that are not in the top 10 Mag 7 Eli Lilly, we see the MasterCard is in multiple funds. We see, and this hasn't gone up as much this year. And Netflix is one we're not actually currently following because it seems like it's overvalued, but um, it's in almost every one of these funds. Look at that. Maybe we should start following Netflix. We'll look into that next time. All right. So all right, that is the talk I have for right now. I hope you enjoyed that, and I hope you have a good investing week going forward, and I'll see you all next time.